Andrew Holland, Chief Executive Officer at Avendus Alternate Strategies, is with us on the show this morning. Andrew, great to have you on. Happy Friday to you. So, lots to discuss and a lot going on, right? A month can be a very long time, I guess, in this kind of a market, because we started August with this big, scare around the carry trade, the scare around the U.S. economy itself. And now here we are. With all eyes on Jackson Hole, the volatility has settled to an extent. But the question is, can the upside continue in the one-track way that the market has gotten almost used to?
Yeah, that's what we're all kind of thinking about, right, in terms of where the market heads from here. So I think there's a few things. One, what will come out from the Jackson Hole meetings today. I think we all kind of working on the basis now that an interest rate cut in September is coming. It's really, is it 25 or 50? The data just suggests that it should be around 25. All that kind of problems you talked about at the beginning of the month have ebbed away, and the economy remains kind of resilient in the US. So that kind of Goldilocks scenario still stands. But I think the markets will continue to worry about is the jobs data showing a bigger slowdown coming, and should the Fed do 50 basis points? Now, I think they should front run the kind of interest rate cycle. I think they should do 50 basis points, albeit that our base case is 25. I think that would give the market that kind of extra fillip that the Fed is ahead of the curve this time. And I think that's the key. The market continues to worry about whether the Fed is behind the curve. And you saw, as well as I did, all those kind of revisions to the jobs data a few days ago. I mean, those are big changes. So I'm not quite sure that the data that they're following is really giving them a good indicator of where the economy is heading. And I think that's what the market will grapple with. So if it's 50, I think markets continue to move higher, not just for globally, but for India too.
Andrew, completely take your point. And guys, just to jog our memories, the revision that Andrew is speaking about, that revision was 818,000 jobs revised downwards. That's what, I was actually a little surprised the market wasn't shaken up yesterday when that number came out. Maybe the impact is playing out with a lag, because that's the biggest revision in US payrolls that we've seen since 2009. I mean, you can revise by a couple of hundred here and there. This was massive, 818,000. So yeah, let's see how it plays out from here.
Well, right now, at least, the Fed CME tool suggests a 25% probability that we will see a 50 basis points rate cut in the September 17th to 18th meeting. Andrew, morning. So what's the best way to construct a portfolio in India now? Because it appears the easy phase of money making is behind. Markets have been consolidating for the last couple of days. There are voices which suggest that mid and small cap, and you're in that camp too, that valuations have just gotten a bit overheated when it comes to the broader market. And it's time now to perhaps focus on, making money, but also preserving capital and, diminishing the kind of risk you take to make that money. So what's the best way to construct a portfolio in India?
Well, I mean, obviously, the way we think about it is that, we continue to play on the themes that we think will, play out over a longer period, because that's where you're going to continue to see the earnings momentum, not just for the next 2 quarters or 3 quarters, but for the next 2 to 3 years. So again, that falls under that defense, renewables, CapEx spending kind of scenario. So I think, as soon as those orders start to be awarded, I think you'll see in the next fillip upwards for these share prices. But the other trends which we talked about before, the electronics manufacturing sector, hospitality, and premiumization in beverages, those are themes that are just not going to go away from you over the longer period. So that's how I'd kind of look to construct the kind of more longer term long-only portfolio, and then look for opportunities which the market presents you in terms of you help get the momentum going. So if the interest rate cycle is now starting to fall, it should be good for our banking sector in India if the RBI follows suit. And of course, we'll all be thinking about October at that next interest rate policy meeting, whether we could see a kind of reduction in interest rates here in India. And that would be, I think, the fillip for the banking sector to move the index higher. And it's a big weightage, and it's done absolutely nothing for a very long time. So I think whilst our patience is wearing out a little bit for the sector to perform, this could be the catalyst for the sector. So that's a kind of a more longer term, but shorter term kind of catalyst for the banking sector.
All right. Hi, Andrew. Good morning. Good to see you, and as always. And from the banking space, preference would lean towards the private, or you still believe the PSUs have something to offer?
No, I think if you're taking the view that interest rates will fall, that's going to be good for a lot of the banks in terms of their bond holdings and M2M. So that falls both for the private and the PSU bank. So I think if you're playing this, you play the whole sector in the short term, and then see which ones have outperformed, and then do your kind of reallocation between private and PSU banks.
Okay, all right. Since you mentioned defense, renewables, as well as power, what kind of exposure do you all have to this space? Because that's clearly the sector, as you mentioned, there's going to be a lot of capital expenditure, a lot of investor interest out there. But valuations, well, on some of these counters have gone through the roof. Your exposure to these spaces right now, and will you increase?
No, I mean, we've reduced, obviously, because of what you've said. I think the next catalyst, as I mentioned previously, will now be the awarding of more contracts. And I expect that will happen from probably kind of next month onwards to the end of the year. And I think that's going to be the next leg. My concern is always is execution, and that's maybe down the road. But until the order... If orders dry up, that's when I think the valuations will start to fall, because I think execution is always a little bit more difficult. But for the time being, for the next 1 to 2 years, I expect that those orders will continue to flow very strongly into these sectors.
You said you've brought down your exposure to these stocks. By how much?
It depends on the stock, and I obviously can't give a portfolio stance away in terms of individual stocks, but we move around within the themes. Obviously, if you're feeling that some of the themes are not have taken a back seat compared to others, then you can shift across. So hospitality is probably where we're a little bit more excited at the moment.
Okay, Andrew, I wanted to ask you about the two-wheeler space, because suddenly that's getting plenty of attention. TVS has done a new launch. The stock is one of the top gainers today. Ola Electric, did you all participate? Do you have a view out there? What's the preference in the two-wheeler space?
Yeah, individual stocks is all different, but I think in terms of Ola's listing, I think we're all surprised at where the share price is. But it's obviously kind of highlighted some of the undervaluations of the other two-wheeler companies in this sector who also have exposure in the EV sector. So I think, if anything, either one share price is telling you that the overall sector is undervalued, or there's some catch up to do, or the other way around.
Okay, Andrew, just to go back to that point on banks and financials, if you could elaborate on that, because there's this huge debate raging around deposits, right? Whether it's becoming more and more difficult for banks to access that cheap source of funding, and whether margins will come under pressure, because the narrative can be painted in a very bleak way if you're a bear, but you don't seem to think so. So just explain the thought process. And also, apart from banks, whether it's capital market related stocks which have had a great run, whether insurers these days, I mean, they're hitting fresh all-time highs. So what else would you look at in financials, and why?
So I think on the banks, I mean, you're correct. I mean, there's no catalyst for the banking sector, because we all know NIMs are under pressure. I mean, there's lots of reports going around at the moment talking about, the age profile of people in the banking deposit system. But there's other products out there, and we talked about this before, like the arbitrage funds, where the yields are higher than you can get in fixed deposits, but you're taxed at a mutual fund taxation, and that's obviously grown very, very, very strongly, and it's taken money away, particularly for those more kind of savvy investors in the markets who can see that these yields are there, and can take daily liquidity or hold it for more than a year. So I think that's part of the problem. Taxation for fixed deposits is a lot higher than other market instruments. So that's a passing phase. Obviously, that will change over time. But what I'm saying is that I think the catalyst has got to be interest rate cycle starting to turn for the banks, which will mean that their bond holdings give you some very huge mark-to-market gains, and obviously, the interest rate environment falling, the economy will start to pick up, and then they can start lending, and deposits will start to continue to grow. So that's the story. I like this story better than like the other stories in terms of insurance or asset management companies. I think they've all had a great run.
Okay, got it. Understood that point. Andrew, great chatting as always. Thank you so much for joining in. You have a good Friday and a good weekend ahead as well. We look forward to the next call soon.